Where do you think volatility has a bigger impact when everything gets nuts, when the
I
noise
think
gets the
it's
loudest? Do you think that the
probably probably
stocks?
individual stocks probably have the biggest percentage move.
It's funny because this is a question that somebody actually sent in this question, and it was on our research thing. My answer to our research team was it has to be the indexes.
Okay, so we're on
And
different sides of the coin.
yeah, we're on different sides of the coin here. And you're saying it's the stocks. I'm not saying it's a layup by any stretch, but I feel like it's got to be under normal circumstances, it's always the stocks that have the higher volatility. But I feel like when everything blows up, it's got to be the indexes that have the biggest percentage move. But we're going to see. So we're going to
Okay.
take a look today because this, I think, is a really interesting discussion. An in-depth analysis of Monday's market drop and the VIX surge, just so it gives some context around what happened. So on Monday, while Japan's the Nikkei index dropped by 12.4% and the S&P dropped by a little over 3%. The VIX surged to 38%, to a level not seen in years. That 12.4% is a huge number, but remember, in Japan, it's a funky market. The rules are very different. It's a legacy exchange. I guess the 12.4% doesn't surprise me as much. If the US market was 12.4%, it'd be a free-for-all. To understand the significance of this move, we need to examine it from various perspectives. So the SPX drop on Monday ranks as the 25th largest single-day decline in percentage terms in the past 5 years, and the 33rd largest in the past 10 years, placing it in the second percentile. Okay, so it's not a move that would, under normal circumstances, kind of scare the children or ring the register. Maybe it's because it happened like back to back with Friday, Monday, maybe because because a lot of it happened overnight or something like that. Just to give it some context, it's in the second percentile, the 33rd largest in 10 years. Let's go to the next slide. So compared to other indices, the S&P 500 has fewer occurrences of large downside moves. The NASDAQ, however, stands down as the most volatile index, experiencing more daily drops of 3% or more. The NASDAQ on Monday at one point was down over 5% just for that one day. So here's the number between 5-year and 10-year. You can see the SPY, a lot fewer than the Qs or the IWM or the diamonds or the Dow. And that's because the Dow only has 30 stocks. The IWM is small cap index. That's always going to be more volatile than the S&Ps, and the Qs are always going to be more volatile than the S&P. The Dow is probably the most surprising thing, but that's just because that is a very small index. Notably, 2020 was the most volatile year in the past decade, followed by 2022. 2020 was the pandemic year. 2022 was the sell-off year. The only 5 instances where the SPX fell more than 5% in a single day all occurred in March of 2020. That was a 35 days of hell when the pandemic first broke out, because nobody had any idea kind of what the hell a pandemic even was. But you can see here the number of occurrences where the greater than 3% move all happened in 2020 and 2022. And then in a 10-year period, I mean, there were a couple around 2015, 2018, none in the election year of 2016, which is interesting. Most were in 2020 and some in 2022, and then one 2024. So why was 2024 such a shocker? And it's just because vol's been so low all year that it caught everybody. So the VIX had an even more substantial move. It jumped to 38 from 23 in just one day, placing it in the top 1 percentile over the past 10 years. So if you look at the S&Ps, it was in the top 2 percentile, but the VIX was in the top 1 percentile. And that's what freaked everybody out on Monday. It wasn't the S&P move per se. It was the size of the VIX.
It wasn't the magnitude of the move. It was the volatility move for sure.
It was all about the volatility move on Monday more than it was the S&P move, for sure. That volatility move was just double the S&P move in relative terms. So the volatility move places it in the 4th largest upside move in terms of points, and the 2nd largest in percentages over a 10-year period. When you look at the VIX numbers, it was far more dramatic, and that's what caused the panic on Monday. That's what scared the children. That's what got the option prices so out of line. Or so rich. I shouldn't say out of line because they were in line, but so rich. The S&P move was actually acceptable. and was very tradable. It's the VIX move that threw everybody off and that added all that noise into the problem and
Sure.
caused all those issues on Monday. Let's go to the next slide. So the correlation between assets when implied volatility is elevated. Here's a graph of that. So currently the correlation is nearing the average level typically observed when the VIX is above 30. And again, we wrote this piece yesterday, so we decided to take a look at the VIX above 20, the VIX above 30, and the VIX above 40. And the reason we wanted to put this up here is we want you to see when volatility screams, like we got to 38 the other day, everything moves the same way. Between Southwest Airlines, emerging markets, Apple, crude oil, Costco, the average was 0.84. When volatility is where it is today, which is just above 20, the correlation is 0.66. So in these kind of markets, you're going to get moves where one goes up, one goes down. The correlation is not that tight. When you get a crazy move like on Monday, everything moves the same way. It's all hell.
Yep.
Nothing bucks the trend.
Everything becomes correlated.
For option traders, the most important thing is how premiums become richer when implied volatility climbs quickly. To explore this, we examine the premium changes in 4 underlyings: SPYs, Qs, AMD, and XLE. We recorded the premiums for selling 45-day 1 standard deviation strangles on Monday and compared it to the premiums when the underlying price was at the same level, but the implied volatility was half, just so you can see. Let's go to the next slide. What's crazy about this is we found the strangles premiums jumped at least 50% higher across different underlyings, and the index premiums, Tony, react more significantly than those of the individual stocks. Here was this on a 1 standard deviation strangle. The SPY premiums jumped 138%. The Q premiums jumped 109%. AMD only 56%. XLE only 50%. So what happens on days like Monday is everybody thinks, oh, I go to an index, I'll sell a strangle in there because I have less risk. Well, the reality of Monday was you had more risk, almost double.
Interesting. I mean, it makes sense when now you think about it, but it's interesting. I didn't think about it that way.
Yeah, I know. So the SPY strangle went from $4 to 9.5 and the Qs went from 4.3 to 9. And AMD moved a little bit and XLE moved a little bit, but you can see this is, like you think you're going to the safer index, but it doesn't always work out that way. Let's go to the last slide. So the takeaways.
I mean, it's twice as volatile, really.
Yeah. So Monday's SPX drop was a significant downside move, placing it in the second percentile of such moves of the past 10 years. Simultaneously, the VIX had an even larger reaction, making it the second largest percentage move. And index premiums increased more strongly than those of individual stocks. Great piece, really good takeaways.